This is the video lecture on liabilities. The first liability that we're going to look at in this lecture are the sales taxes payable. Now the way this works is that every time we complete a sale, the sales taxes are going to be collected from the customer. And the sales taxes that we collect, that money actually has to be sent to the state. So that's not actually our money to keep. So that is why the sales taxes payable represent a liability. Now the actual percentage of sales tax varies from state to state. Some states might charge as little as 4%, some as high as 9%. So it always varies and always depends upon the location of the actual business. So in this example of sales taxes, a company has sold $600 worth of merchandise, and this is to a customer in a state that happens to be charging a 5% sales tax. So as a result, a journal entry will be required. Now in this case, I'm debiting cash $630. Now where does that $630 come from? Well, the sale was $600, but we have to charge that additional 5% in sales tax. So this amount is 105% of the original sale. So I'm going to multiply 600 by 1.05. And 105% of 600 is 630. Then on the credit side, I will credit sales $600 to acknowledge the revenue. And then of course I'm $30 out of balance, and I have $30 on the credit side, which goes to the actual liability, sales taxes payable. And remember, the pattern that you always see for liabilities is an initial credit, because liabilities are actually debit negative, credit positive. So we always credit a liability to establish it, and then when the liability is resolved, it will actually be debited. Now the next liability would be note payable. And in an earlier lecture, we talked about note receivable. So now we get to see the other side of that transaction, the note payable. This is when we owe money. And like I said, if we owe money, typically we would put that to accounts payable. But if there are these two extra conditions that are in place, then it actually would be a note payable. And of course the two conditions are that it is a written agreement and that interest is being charged. So in this case, we're going to borrow $2,000. Now remember, when we talked about notes in the past, we were talking about notes receivable, and we were the company lending the money. Well, now the tables have turned. Now we're looking at it from the other point of view of borrowing the money. So we're going to borrow $2,000 by signing a 90-day 5% note, and this is occurring on December the 16th. Now right away I see a problem. I'm borrowing this money awfully close to the end of the year. And remember, anytime these things happen near the end of the year, it's going to cause us to have to accrue certain things. So this first journal entry, this one is recorded on December the 16th. This is the day that I sign the agreement. I will receive the money that I'm borrowing, which is the $2,000 cash, and at the same time I have an obligation under note payable to pay back that $2,000. So that's the initial entry on the 16th. Then on December 31st, because it is the end of the month and the end of the year, I have to accrue interest. Now in this case, it's only been 15 days. So 15 days worth of interest on this particular note would work out to $4. And that's based on my simple interest formula. So I book that as an interest expense on the debit side, and because I haven't paid for it yet, that's another liability, interest payable. And interest payable is a liability just like note payable, just like account payable. Any of those are all going to be liabilities. Then finally, on March 16th of the following year, I finally pay the money back. Now, if you look all the way down here on the credit side, when I pay that money back, I have to pay back the principal plus interest. So the entire span of the note payable, according to simple interest formula, gives me $25 worth of interest. So I have to actually pay $2,025. I will remove the liability at $2,000, and then I have a $25 difference there. Well, part of that is going to be removing the other liability of the interest payable, so that leaves another $21 in interest expense. So when you think about it, I didn't pay the $25 until March 16th, but if I back up and look at last year, $4 of that was an expense last year, and $21 of that is an expense in the current year, even though I didn't actually pay for it until March the 16th. So that's what we achieve by doing these accruals. And we always have to do that when things happen very close to the end of the year. Now, the next liability that we're going to take a look at are the warranty liabilities. And from time to time, if we sell a product, we sometimes offer a warranty. And offering a warranty, sometimes that will entice someone to buy something because they'll feel more confident about the purchase if we give them a warranty. And the warranty is a guarantee or a promise. We're promising them that this product will not be defective and that it will work properly. But when we make a promise like that, how much is that ultimately going to cost us? Well, to be honest, we really don't know. We don't know how much money we're necessarily going to spend on warranties. It's possible that none of the products will turn out to be defective. Then again, it's possible that many of them will be defective, and it could cost us a lot of money. So what GAAP requires is that we at least go ahead and make an estimate about how much the warranties are going to cost. And that estimate is either based upon our past experience or possibly failure rates that we've noticed with that product in the past. So the warranty example, we're going to sell a used car, $10,000. What kind of a warranty do we offer? Well, we're going to offer a 1-year or 12,000 mile warranty that only covers parts. Now, why are we offering that warranty? Well, sometimes that's a good way to motivate people or entice people to buy our product. And maybe that warranty was the deciding factor that led that person to make that final decision to go ahead and buy that car. So it's a way of encouraging people to buy things, but it could cost us money. Now, we don't really know about this car. We don't know, it may never cost us anything. But then again, it might break down, and if that happens, it is going to cost us. So based on their past experience, they believe that about 5% is a pretty good indicator of how much it's going to cost us. So 5% of $10,000 is $500. So we'll go ahead and debit warranty expense, and we'll credit a new liability that is simply an estimated warranty liability. Now, we haven't actually spent any money yet on this warranty, but we're doing this ahead of time to be preemptive and to be conservative. And this is a GAAP requirement that if we do offer this warranty, we at least need to be, based on our past experience, we at least need to be cautious about this and record a certain amount to make sure that we have a good warning. Now, the next type of liability is called a contingent liability. And these are a special type of liability. Contingent liabilities, this represents something that may or may not happen. Because if something is contingent, that means that it may happen. It depends on other factors. So if this does in fact happen, it will cause us to lose money. But we don't know that it's going to happen. So the question comes up, what do we do about this? How do we record this? Do we even record it? So a really great classic example of a contingent liability would be a lawsuit. If we're in the middle of a lawsuit, And if we lose that suit, we may have to pay damages. But we haven't lost yet. What do? Do we just do nothing? Do we record it? So that's a good question. We have to answer that question, and we have to follow the GAAP guidelines. So the two questions that we have to answer, and this is partially based upon opinion. Number one, how likely is it that the event will occur? Do we think the chances are very strong? Do we think the chances are very unlikely? Do we think it's somewhere in the middle? So depending on how we feel about that, we might potentially record that differently. And then the other question would be, is there an amount involved? Can we reasonably estimate how much this is actually going to cost? So those are the two questions that we're interested in when it comes to recording these types of liabilities. So in this case, we have different options, and the very first option would be if the event is probable and estimable, then we will actually record a liability. In other words, if we think the chances are very strong and we have a very good reasonable estimate as to the amount, then the conservative thing to do would be to actually go ahead and record that as an actual liability. But the other option would be if we think this event is merely possible, then we would just simply disclose the information in the notes to the financial statements. So that's more of a middle ground approach. We're not actually going to book a liability, but we at least feel that we should give people a warning and at least put it in the notations to the financial statements. And we would do that if we feel that it's just possible. In other words, we don't think there's a strong chance, but then again it is possible. And then the final option would be if the event is unlikely to happen, then we actually just wouldn't do anything. So those are the possibilities. Now bear in mind this is based on opinion. So thinking about that example that we talked about earlier, what if we are involved in a lawsuit? You know, it's possible that we think that it's very likely that we're going to be found guilty, and we know a really good reasonable estimate as to how much we're going to pay, and if that's the case, we'll go ahead and book it as a liability. Then again, at the other end of the spectrum, what if this lawsuit is totally frivolous? We think there's almost no chance that anything's going to happen. We would just do nothing, and if it's somewhere in between, we would at least put it in the notes to the financial statements. But then again, like I said before, it is based upon opinion, and just because you think it's a frivolous lawsuit and you're not likely to lose, you could be in for a huge surprise. So all this is somewhat opinion based, but this is how we would record our contingent liabilities.